You are watching Daily Market Pulse. Markets closed Friday, May 15, 2026. Here is where everything ended the week. If you want a clean daily read on macro and market risk, subscribe for the next briefing. Markets closed the week mixed. Inflation fears reignite as yields spike. Today's agenda: Friday's stock market close. Treasury yields spike above 4.6% on inflation data. Gold holds strong as inflation hedge. Silver volatility continues despite strong fundamentals. Oil prices ease despite geopolitical tensions. Bitcoin dips as crypto sentiment turns fearful. Let's start with how the stock market finished the week. The stock market closed the week on a mixed note, with the S&P 500 finishing near 7,444. Early in the session, AI stocks were leading the charge, pushing markets higher. But then the inflation numbers came in hotter than expected. This sent the 10-year Treasury yield soaring past that critical 4.6% resistance level. Suddenly, the narrative shifted. Instead of anticipating rate cuts, investors started pricing in a higher chance of rate hikes. This is a big deal because higher yields make borrowing more expensive for companies and can really pressure stock valuations, especially for those growth stocks that depend on future earnings. The market's reaction was clear: caution. We saw a pullback from earlier highs as the broader market sentiment weakened. The narrow leadership we've seen, where just a few big tech names were driving gains, became even more evident. Looking ahead, all eyes will be on the Federal Reserve. Any hints about their next move on interest rates will be crucial, and we'll be watching that 10-year Treasury yield very closely. If it continues to climb, it could spell more trouble for stocks. The key takeaway for you is this: the market is now really focused on inflation and interest rates, and the easy money party might be winding down. And that surge in yields was directly tied to this next point. Let's talk about what's really moving the markets: interest rates. On Friday, the 10-year Treasury yield decisively broke through that important 4.6% level, closing the week at 4.6%. This wasn't a small move, it was a significant jump, and it was directly caused by that hotter-than-expected inflation data we saw. Remember, inflation means prices are rising faster than usual. The market is now looking at this and thinking, oh, the Federal Reserve might not be able to cut rates anytime soon. They might even have to raise them again to fight this inflation. This is a really big deal. Think about it. Treasury yields are like the foundation for many other interest rates. When they go up, so do mortgage rates, car loans, and the cost for businesses to borrow money. This makes everything more expensive for all of us, for investors. It means that safer investments like bonds suddenly look a lot more attractive compared to stocks, which are considered riskier. So we saw an immediate reaction. Stocks, especially those growth companies, felt the pressure. The market is now bracing for a scenario where interest rates stay higher for longer. Looking ahead, the big number to watch is 5%. If that 10-year yield keeps climbing and breaks above 5%, it could signal a much tougher inflationary environment and lead to even bigger price swings in the markets. We'll also be hanging on every word from the Federal Reserve. Their comments will be crucial in understanding their strategy. The main takeaway here is that the market is now seriously concerned about inflation and the potential for higher interest rates for an extended period. While stocks faced pressure, gold offered a different story. Now let's turn our attention to gold. Gold prices saw a nice little bump on Friday, closing around about $2,385 an ounce, up less than 1%. And why is gold doing well? It's acting exactly like we expect it to, as a hedge against inflation and a safe place to put your money when there's a lot of uncertainty in the world. Even though Treasury yields were jumping and putting pressure on stocks, gold held its ground. This is because when prices are rising faster than usual, meaning inflation is high, your money in the bank loses value. Gold, on the other hand, tends to hold its value and sometimes even go up. The current situation, with high energy costs and global tensions, is exactly the kind of environment where gold shines. We're keeping an eye on the COMEX inventory levels, which are stable, showing consistent demand. Gold is trading at about $4,560, lower on the day, down about 2%. The key takeaway here is that gold is proving its worth as a reliable asset when the economic outlook is cloudy. Silver, on the other hand, experienced a much different story. Silver, however, had a very different Friday. It experienced a sharp drop of over 13%, closing at about $76 an ounce. Now, this might seem alarming, especially when you consider that analysts like J.P. Morgan are forecasting an average price of around about $81 an ounce for this year. This kind of sharp move, despite a positive long-term outlook, really shows you how volatile silver can be. Silver is unique because it's used in a lot of industries, like electronics and solar panels, but it's also seen as a precious metal, like gold. So its price can be influenced by both economic growth expectations and by people looking for a safe place to invest. On Friday, it seems like short-term market sentiment and perhaps some profit-taking after recent gains really took over, pushing the price down. But the fact that analysts are still bullish suggests there could be a rebound, a mean reversion as they call it, back towards those higher price targets. So what to watch next? We'll be looking for signs that silver is stabilizing, and if it can start moving back towards that about $81 forecast. Any good news on industrial demand or a calmer global outlook could help silver bounce back. The big takeaway here is that silver is a wild ride right now, with big swings possible in either direction. Moving on to the energy markets, oil saw some action. Let's talk about oil. WTI crude futures closed Friday at about $100 a barrel, down about 1.4% for the day. This dip came after a week where oil prices had been climbing, largely due to those ongoing geopolitical tensions, especially involving Iran, and some underlying issues with supply. So why the pullback? It looks like traders might have just decided to take some profits after the recent run-up. But here's the important part. Even with this slight dip, oil prices are still elevated, and the reason is that geopolitical risk premium is still very much in play. This means the market is still nervous about potential supply disruptions. Oil prices are a huge factor in inflation, affecting everything from your gas prices to the cost of shipping goods. So even though we saw a bit of a breather on Friday, the potential for prices to jump again is definitely there if tensions flare up or if supply gets squeezed further. What to watch next? Keep a very close eye on any news coming out of the Middle East and listen for updates on oil production from major players. The takeaway here is that while oil prices eased a bit on Friday, the underlying risks are still very much present. And that brings us to the world of digital assets. Now let's look at Bitcoin and the broader crypto market. On Friday, Bitcoin dipped to around about $78,985, down about 2% for the day. This move wasn't happening in a vacuum. The Crypto Fear and Greed Index, which measures investor sentiment, dropped to 31, which is firmly in fear territory. What does this mean? Well, when inflation numbers are high and interest rates are expected to stay high, investors tend to get nervous about risky assets, and cryptocurrencies are definitely considered risky. This fear can lead to a domino effect, where investors start selling off their crypto holdings, which can cause prices to drop even further, leading to what we call liquidations. We saw this fear spread across other major cryptocurrencies too, like Ethereum and Solana. The market has clearly shifted from feeling neutral to feeling downright fearful. So, what should you be watching? Keep a very close eye on those spot Bitcoin ETF flows. If we start seeing consistent money leaving these ETFs, it's a strong signal that investors are pulling out. And of course, if the overall economy continues to show signs of stress, that's only going to put more pressure on the crypto market. The key takeaway here is that the crypto market is feeling the heat from inflation fears and rising interest rates. And sentiment has turned decidedly fearful. This economic picture is also heavily influenced by the consumer. Let's talk about the backbone of the economy, the consumer. The analysis shows that the consumer cushion, those savings people built up, is almost gone. People are spending down what they have left, and when you adjust for inflation, real retail sales are actually negative. That means people are buying fewer goods and services, even if they're spending more money. On top of that, we're seeing more and more people falling behind on their credit card payments and loans. This is a clear sign of financial stress. Why does this matter so much? Because consumers drive a huge part of our economy. If they stop spending, businesses suffer, jobs can be lost, and the whole economy can slow down, possibly even leading to a recession. While the stock market has been doing okay, this underlying weakness in consumer spending is a big concern. We're seeing a split. Some big companies are doing well, but everyday people are feeling the pinch. So, what should you watch for? Keep a close eye on those delinquency rates. If they keep climbing, it's a bad sign. And we'll be looking at future retail sales reports to see if this trend continues. The bottom line is this: the consumer's ability to spend is weakening, and that's a major warning sign for the economy. Finally, let's look at a structural shift impacting finance. Let's wrap up by looking at a bigger structural shift that's happening in finance. There's a growing argument that decentralized protocols, think of them as systems with rules written by the users themselves, are actually better than centralized regulatory frameworks, which are like rules imposed by the state. The idea is that these self-written rules offer more stability and predictability. Why? Because they're explicit and enforceable. Unlike government rules that can change on a whim, this preference for having control over your own financial contracts is a powerful idea. It suggests that people are starting to trust systems where they have more say, and that could have a big impact on the future of money. This is why you hear so much about Bitcoin and other non-custodial assets. They operate on these decentralized, immutable ledgers, meaning they're not controlled by any single entity. While this wasn't a direct Friday market move, it's a fundamental argument that's shaping long-term investment thinking. We're seeing more and more interest in assets where you have direct control. So, what to watch for? Keep an eye on how many people are using these non-custodial wallets and decentralized platforms. If these systems continue to prove reliable and secure, it could lead to a major shift in how we think about and use financial assets. The key takeaway here is that the trend towards self-governed digital systems is a powerful force that could reshape the entire financial landscape. Now let us turn to today's live market snapshot, where gold, crypto, stocks. Now for our daily financial market update. Here is where the key asset classes stand as of Saturday, May 16, 2026. Gold is trading at about $4,560, lower on the day, and is sharply lower over the past 5 sessions. Silver is at about $78, sharply lower today, and sharply lower over the past 5 sessions. In crypto, Bitcoin is at about $78,900, lower on the session and sharply lower over the past 5 sessions. Ethereum is at about $2,200, lower today. Other major crypto, Solana at about $88, sharply lower, BNB at about $664, lower, XRP at about $1.422, sharply lower. On equities, the S&P 500 at 7,408.5, lower. The Nasdaq at 26,225.1, lower. The Dow at 49,526.2, lower. Internationally, the DAX at 23,950.6, lower. The Nikkei at 61,409.3, lower. The FTSE at 10,195.4, lower. On the bond side, the 10-year U.S. Treasury yield is at 4.6%, strongly higher on the session, and the 30-year yield is at 5.1% higher. Elevated yields continue to place pressure on risk assets and growth valuations. Rounding out the macro picture, WTI crude at about $101 per barrel, slightly lower. The dollar index at 99.27, slightly higher. Euro dollar at 1.163, slightly lower. The picture is mixed across asset classes, with no dominant directional theme yet. Investors are watching macro catalysts closely before committing to a clear risk stance. The week concluded with a stark reminder of inflation's persistent grip. Rising yields dominated headlines, leading to a cautious sentiment across asset classes. We'll look at how this sets the stage for the coming week. Thank you for your attention, and we will see you again tomorrow.